Ladies and gentlemen, Assemblyman Conover has just left the building. It is great to welcome back Chuck Malamut in studio. The following program is presented by Chuck Malamut. He is a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck. They do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Chuck Malamut is the managing director. He leads his group, the Malamut Group, at Morgan Stanley's Northfield office, 609-383-2010. When you want to sit down with Chuck and his team to review your financial goals, your financial dreams, and your individual situations, give Chuck a call. Tell him I sent you, 609-383-2010. Chuck?
Good morning, Harry.
This has the potential. It always is great when you're here, but we have news to report. I mean, Brexit wasn't terminal after all. I never thought it was, as you know. I said it was going to be a couple-of-day event. And look at the markets are happy, and this is pretty interesting times.
You know, Harry, interestingly enough, we did work our way through Brexit relatively quickly. It was, you know, if you go back over time, we've had these multiple corrections within the marketplace, and it seems as if the market is fairly resilient at this point in time. But I still would caution you and your listeners that while Alcoa reported yesterday, revenues were down, but they beat. You know, they beat the ultimate earnings number. You know, we're right on the heels of second quarter earnings, and there's all kinds of discussions that we were at the trough at the end of the first quarter, and now there might be some carryover into the second quarter. So I think you need to be just a little cautious here with respect to the market. I mean, you know, the media just does a remarkable job reporting yesterday that the S&P made all-time highs. The Dow Jones is about 100 points behind their all-time high. The NASDAQ is lagging somewhat on a comparative basis. But, we have to be concerned with what is happening, not just here domestically, but also what is happening internationally as well.
Yeah, I like your approach there, and I'm not going to issue irrational exuberance, but I think it is pretty positive the way that in just several days something that was just off the charts hyper negative settled down quite a bit.
Well, Harry, if you remember the evening here in the U.S., the evening of the election, was rather late for us as we're getting the results, and then by the morning, the world was totally taken aback with what the results were. And now it seems as if things have calmed down somewhat. I don't think you can send out the signals that everything is all clear ahead. But I certainly would be more comfortable owning domestic equities at this point in time than some of those international counterparts. But look, anything goes, in this crazy world of ours. I mean, I was listening to you and Kirk this morning, and I just shake my head in total disbelief of some of the things that are happening. And, just one general observation, Harry, not to get off track here, but it seems as if, when you drive by, a flag nowadays, it seems to be at half-mast more times than it is at full mast, and it's just
great observation.
Really, really sad state of affairs. And if you're not concerned, you really need to be concerned, because what has happened here over the last several years, it's going to take many years to repair the collateral damage that has occurred, within this great country of ours.
Now let me give you the upside to that. when we do change, and I believe we are going to change because nothing stays the same and we cannot continue on this path. So I believe we're going to make a positive change in the not-too-distant future. I think that really opens up an incredible opportunity for our financial markets, for healthy employment, for really getting our mojo back in many, many different ways. So I'm very proud. You know, I've said this for the past 7.5 years, Chuck, on your show and when we're doing, the regular Hurley in the Morning programming, that I've been very impressed with our financial markets and their resiliency in the midst of all of this turmoil and tumult and just craziness that's been going on. I think it's pretty commendable, actually.
Well, Harry, I always look at you before I say some of the things that I say, and looking for a reaction, or maybe what I'll call
smiling at me already,
or
kids.
I'll call an overreaction. But
I never overreact.
Well, that's not necessarily true, but we'll save that for another day. But
truth in broadcasting.
The fact, I mean, you hit the nail on the head there. Let's talk about GDP here for a second. Yeah. We expect that the GDP growth is going to average around 2% for the remaining part of this particular year, which would be consistent with that slow pace since the end of the Great Recession.
So for the first time in American history, for 2 complete presidential terms, we will never have grown at 3%.
No.
And that's never happened in the entire history of America.
Well, I mean, look.
Not even during the Great Depression.
If you talk to large businesses, small businesses, and mom and pop organizations, it just seems as if you can't negotiate your way to sometimes to profitability because you have a lot of friends that are in your pocket, looking for your resources before you can keep some for yourself. And that obviously has to change. We'll find out in a relatively short period of time if it is in fact going to change or we're going to have more of the same.
Chuck, let me ask you just a side issue because, I bring it up from time to time when I think it's relevant, and that is the price of a gallon of gasoline. Not long ago, I'd say within the last week, it was $207.9 for a regular gallon of unleaded gasoline at our corner, Ma shop in Scullville, EHT. Then all of a sudden it was down to $199.9. Then I drove this morning to the palatial studios of Hurley in the Morning at Town Square Media, Atlantic City. It's now $197.9, something I think very unusual for gas prices to be going down in the peak of summer.
Harry, well, I think we've been through the blend, that usually is at the beginning, not so much the middle or the end. But I think kind of put this in perspective here. If you look at the price of the gallon of gasoline, nationally speaking, as of last Friday, it averaged unleaded 2.29. When we closed the year out, we were at 2.04, which represents an increase of 12%. And you have seen, very, very good strength in the energy market so far this year as we got to the trough. And remember when oil prices were, there were some very, very large firms predicting $20 a barrel and $15 a barrel and, several hundred bankruptcies in the oil patch. And there were some, but that did not materialize. But on a comparative basis, Harry, when you look at where we were a year ago, the price of unleaded was at 2.79 versus 2.29, which represents a 21% decrease. And you see that reflected now in the fact that there's more people traveling over this past July 4th than there were, basically in the last decade because of these very, very inexpensive oil prices. The price of West Texas was at $37 a barrel back in December. We're now at $45, and a year ago we're at $51. So on a comparative basis, gas has decreased more year over year than the price of West Texas. So, I mean, that's basically, our thoughts on where we are with respect to unleaded and where we are with respect to oil, and the fact that if you look at energy, third best sector within the S&P, up 15% year to date. Pretty remarkable run for sure.
I totally agree, and obviously that's very good for people having additional discretionary spending, perhaps trips that people will take that they otherwise wouldn't take. So it's a very good thing.
Yeah. So if you look at the S&P all into itself, you're up about 6% year to date, and we traveled there. You think about it.
For the year we've been through, Chuck, that's pretty remarkable, actually.
But Harry, most of that has been accomplished, in basically in the last several weeks.
Brexit.
And now as we push through and make all-time closing highs in the S&P yesterday, and now we have a fairly solid open as we get in today's actions, and we've had good activity overseas. It looks as if the market needed to have that minor correction to sort of reset itself. As is hopefully we push through that number, and we continue to make higher highs.
Brief timeout. Coming right back. Don't go away. He is Chuck Malamut, the official financial advisor for the Hurley in the Morning program. 609-383-2010 is Chuck's phone number. The Malamut Group that Chuck leads at Morgan Stanley's Northfield office, 609-383-2010 for all of your financial planning needs. Turn to Chuck Malamut, the Malamut Group. They'll introduce you to their perfected concept of total asset management coupled with the all-important asset allocation. We'll be back with Chuck in just a few minutes. Don't go away. Thanks very much. We're back 20 minutes past the hour. So, Chuck, we talked a little bit about a market update, little Brexit.
Yeah, well, let's get back. Let's spend a couple more minutes in Brexit.
Yeah.
I think I want to give it justice here, full justice, because obviously the people have spoken. Now that we're a couple weeks after the vote, the markets have certainly calmed down, but investors are still faced with a fair amount of uncertainty. So, the good news is that if you look at the economies here in the U.S. And a good part of Europe, they were accelerating before the referendum. We still think that the U.S. is going to continue on that slow growth path. Consumer spending here should benefit from our still strong employment. I know that you and Kirk kind of chatted about that. We might want to talk about that in a minute. Increased wages, a housing market that looks to be a little bit firmer, and investors are continuing to save somewhat. So conversely, on the flip side, when you look at Europe, not surprisingly, they're going to be the most adversely impacted by all this. We think that growth-oriented markets, such as emerging markets and markets like Japan, are going to also take somewhat of a hit. Global growth expectations are going to weaken, and deflation fears continue to increase. So that's why every day, Harry, if you think about it, how do you make all-time highs in the S&P? In the meantime, our Treasury, or our 10-year Treasury note bond is priced in the 1.35 area.
Anybody?
And because that, typically there is somewhat, the signals are somewhat mixed here. When you look, because think about it for a minute. Where were we back in the beginning of the year? We were over in the mid twos, I believe, 2.5, maybe even higher. And the predictions were that we were going to go higher, not lower. So again, all the economists got that dead wrong.
Are any serious people still talking about reverse or negative, rather?
Well, look, if you have, I don't remember I don't want to give you a bad statistic, but if I heard it correctly, $12 trillion of global debt right now is at negative rates of return. Wow. Your friend Janet Yellen had spoken about negative rates at one point in time. Got virtually trashed for it. I don't think we're going there, but certainly what is happening here in the U.S. because of what is happening overseas, and the fact that our paper, for the most part, is of better quality than oftentimes what you find overseas, that there's now more demand for our debt than there was, previously speaking.
Chuck, this is a little bit maybe off the beaten path, but I think it's an important question. Why was the initial, in your estimation, and I know some of this is a little bit subjective, but why was it so hyper negative when the United Kingdom opted out? So they did what, quote unquote, became Brexit. They got out of the European Union. The United Kingdom maintains its own currency, so it wasn't like they had to oh my gosh, what are we going to do? We don't even have money. So it's not like they needed the euro. They have their own currency. They can conduct free trade. They can, they just didn't want to stay in the European Union and go with the group. They opted to go alone. Why was that considered? And they'll have a new prime minister over it tomorrow. Cameron said he was going to stay till October. He's leaving tomorrow, and I forget her name, but it will be a female. The new prime minister will take office, I believe, tomorrow. So what was so hyper negative about
Harry,
it?
I think it was the unexpected. If everyone, it's like we have the old. The old story where everybody goes to the left side of the boat, what happens? Everybody goes to the right side of the boat, what happens? And that virtually is what happened here. I mean, the expectation, overwhelmingly expectation, 2 days or a day out, was that this was going to be a non-event. And,
all they needed to do was call me.
And and obviously, we know what happened.
Yeah.
And in the markets, on what happens is, Harry, it's a matter of you get that initial news and you either sell or buy very, very quickly, and then you ask questions later. So I'm thinking that had a lot to do with it. And you think about it. So Friday morning we came in, we were down 600 for the day. Everyone had an opportunity over the weekend to think about it, down another 200, and then we had this reversal, and now we are sitting, up fairly significant, not fairly significant. We went from negative territory to positive territory for the year, and if we asked your listeners, what is likely that be happening, I think the majority of them would say it's highly unlikely that it would happen. So, if you learn anything from this exercise, it's the fact that if you expect the market to go left, you better really be prepared for the market to go right.
And also pay attention to what you have called for the last 25-plus years on this program, Chuck, geopolitical events, because the defeat of that question was not on the economies of scale, not anything to do with economics at all. It was a geopolitical issue that tipped that question.
And absolutely. So what has happened since, Harry? As I mentioned to you before, global bond yields, have reached record lows as investors are now, looking, for safety, and additional further monetary policy easing within that post-Brexit era. So, the banks are going to do not the banks so much, but the EU is going to do everything in their power, Harry, to make certain that this transition, doesn't put those economies into recession, because there is a very, very strong possibility that you're going to see job loss as particularly in the financial services sector of the world, as they move out into friendlier parts of the world, so to speak.
Good analysis, Chuck. We're going to step aside. Coming right back. One more power segment straight ahead. This portion of Early in the Morning with Chuck Malamut, brought to us in part by the Harbor Pines Golf Club, owned by the legendary Gerwick's family. They are the official, they are the exclusive golf club to the Early in the Morning program, located at 500 St. Andrews Drive in Egg Harbor Township. Fridays, I didn't get a chance last hour to tell you about Fridays at Harbor Pines Golf Club. Very special, really such an attractive opportunity for you and yours to consider. The deck opened several weeks ago to much enjoyment for the season, because the deck has been there. Live entertainment. Very, very significantly discounted adult beverages available. $25 8-ounce Maine lobster tail dinner. And if you pair that with a 9-hole golf rate of only $25 after 4 p.m. So you could go grab yourself an after 4 p.m. type 9-hole rate of $25 and go right to dinner. It just is a spectacular opportunities on Fridays at Harbor Pines Golf Club, where memberships are voluminous, all different types and availability based on your schedules. Golf outings, fantastic for that. Weddings, banquets. They have a wonderful practice facility. They have the golf academy, the wonderful grill room. It's all happening at Harbor Pines Golf Club. To reserve, you can book a tee time on the World Wide Web at harborpines.com or dial 609-927-0006. 609-927-0006. Harbor Pines Golf Club. Tell them Hurley in the Morning sent you. Back with Chuck Malamut in 3 minutes. 32 minutes past the hour. Chuck Malamut is here for all of your financial planning needs. His group, the Malamut Group at Morgan Stanley's Northfield office, they're just a phone call away at 609-383-2010. All right, so Chuck, you did the market update. You nailed it. The Brexit, outstanding analysis by Chuck Malamut. Did we fully cover the economic growth signals?
No, Harry, we kind of chatted about that for a minute. So, as we mentioned earlier, as we got through the Brexit vote, the U.S. Treasury yields, plummeted, and have since moved into this record low territory. Normally, low yields are a sign that the economy is weakening, and if not heading into the big R word, the big recession, and or that we could be faced with some deflationary concerns, but the underlying economic fundamentals, as we know them today, Harry, do not match up to what the yield levels are telling us. So let's kind of take a step back here.
What's the disconnect? I guess you're going to tell us.
The Federal Reserve Bank of Atlanta, recently estimated their second quarter GDP to come in around 2.4%. The Federal Reserve of New York recession model, as is referred to, is only forecasting an 8% chance of a U.S. recession over the next year. So that Harry, those stats are very, very inconsistent with where the 10-year is trading right now. Around that 1.35, 1.4%. So the question is, what is correct? We think that the low Treasury yields should not be mistaken for a signal that the U.S. economy is in serious trouble. Now, we think the main reason behind all this, that you have all these forces outside the U.S., the global forces seem to be the main driver of what is happening here in the U.S. There's this run, so to speak, to buy U.S. securities, whether good quality corporations or U.S. treasuries, and as a result of that, that's pushing prices higher, pushing yields lower. So, we think that because you've had these negative rates, we kind of chatted about, a little bit earlier in the show today. That seems to be the main reason that rates are where they are. You have global weakness that is impacting as well. But we still think that what is happening here, we're going to grow at that 2%. And that's actually, Harry, that's a lot better than what is happening, in different parts of the world. I know that you and Kirk talked, you talked about a lot of things. You talked about, U6 and U3. And what is the differential? And, I'm really, really surprised. I'm actually a little disappointed with you, Harry.
Well, I'm waiting to get to this. Don't be disappointed.
Because
we got 10 minutes left.
Because what has happened is, they printed the June jobs report.
Yeah.
At a larger than expected 287,000.
Yeah.
But the unemployment rate
ticked up.
Moved up
0.2%
from 4.7 to 4.9.
Don't be disappointed in me, because this was absolutely going to happen whether you brought it up or not. I was bringing it up before the end of your show to say that this is proof positive to what I have been saying, that if you bring people back into the workforce, that's actually going to increase the unemployment rate. Isn't it interesting how 287,000 jobs, which was unexpected and a number we haven't seen in a while, we used to see it all the time in better times, how that took the unemployment rate from 4.7 to 4.9, which means if they weren't so busy, the optic of just pretending that things were getting better and instead of working hard to make things better, the low unemployment rate that no intellectually honest, serious person ever use that number as a sign that things were good, because it did not have the feeling of a full employment market in America. But the first time that people came back into the workforce, the unemployment rate actually ticked up. I'm going to repeat, from 4.7 to 4.9%, proving my point.
Well, Harry, look, when you look at the number, and it's, I remember it crossing the tape, so to speak, and I turned the mic and I said, "Is this a misprint?"
No,
because of what happened in May.
Yep.
And the May numbers just being so awful.
Yep.
and missing the mark. But what I think a lot of people, I mean, everybody's grabbing the headline, they're going with it, and they don't really get much into it. But what happened was, no sooner did they announce the 287,000 new jobs, and the fact is that they had downward revisions, for prior months, and at the same time, the average hourly earnings, or a measure of what we call wage gains, slowed as well last month. So, some of the internals have disappointed as we look at it. The headline payroll clearly points to a healthier labor market than we had, back when we were in May.
And by the way, you touched on previous months. I wouldn't be surprised if over the next couple of months we don't see this get revised down. I think it was sort of convenient good news that I sort of looked at a little bit crooked. I mean, I'm looking at the time of year that it is, maybe that seasonal hiring or something. I don't know, but I was surprised by it.
Yeah, well,
but it was.
I wasn't. I'm not surprised that you were surprised by it. How's that?
Well, I mean, I'm just going by the track record. It's a month that we used to see all the time, but we don't see it very often anymore. But I also thought that it was very validating that it took the unemployment rate and raised it as it was getting lowered. More bad news we got, the lower the unemployment rate was getting.
Yeah. So in the meantime, we're at 4.9. Full employment, Harry, is what's less than
6%.
Okay, so I guess we're
at full employment.
We're at full employment at this point in time.
But go to the U6 report, and we're not at that number.
Yeah. So interestingly enough, when you on a comparative basis, when you look at U6 versus U3, it clearly states that we have, we have a fair amount of problems here.
Well, how does a nation with 315 million people, how do we stay healthy when 100 million people are not in the workforce? That's pretty staggering number.
It's going to be challenging for sure. Yeah. I mean, you look at.
Well, we're going to have more takers.
I remember I heard one of your callers this morning. I can't remember shouting she was up in Philadelphia for maybe 10 days and. Yeah. Driving around and just seeing, everything.
Closed strip malls and all kinds of things.
Yeah, and so you have it, not different than what we're seeing here. I mean, you look at the average, the average sales price of real estate. I mean, we have a lot of work to do, not only here locally, but still within this country to get ourselves tracked. To where we need to be economically. I mean, it's we're muddling through. I guess does that make any sense?
Well, it makes perfect sense. And once again, I applaud our financial markets that have been mature, that have been resilient, that are hanging in there, that are somehow just keep coming back no matter what happens. And this has been, I think maybe you'll agree with the statement, this has been quite a roller coaster ride for the first 6+ months of this year.
Harry, look,
But you would often say, if you just closed your eyes and it was today's date, a lot of that harrowing, you wouldn't
have experienced the everyday ups and downs within the market. But
then, of course, Chuck, people make decisions. See, no matter how competent the advice, how professional, how appropriate the advice, people do get skittish. Like, for example, Chuck, I'm not asking you to talk about your clients or anything, but after Brexit, in America, people bailed after a terrible day.
Of course they did, because it's evidenced in what happened with the prices within the marketplace. So,
and then you look at what happens a relatively short time later, which is why I think what you talk about a lot of times is don't get hung up day to day.
Look, the news media does a remarkable job communicating what goes on in the world, and with a bias certainly more to the negative side than to the positive side. So you have to recognize that when you're putting your money to work, to clearly understand, what are my goals, dreams, aspirations. Harry, I had the same discussion with a fairly well-to-do client just the other day, and the conversation started, well, maybe we should just take profits to pay down some outside debt. I said, well, maybe that's a good idea, but I think we need to be a little more specific in having this discussion, which ultimately led to saying, why don't we go back? It's been about a year now, and do a revision or an update with respect to your financial plan, and let's try to figure out what is the probability of your success based on what you currently have, using historic norms with respect to rates of return, and actually dialing it back a little bit and say, like, let's use worst case scenario. And when you have those kinds of discussions, if you're working with an advisor, and the advisor is not having those kinds of discussions with you, then you really need to look at the relationship to clearly understand, am I being represented, correctly? Or is everything being done the way it should be done? So, and Harry, that's nothing different than what we've done now for, close to 30 years now. Without a plan, it's like getting in your car. Well, now everybody has a GPS, and they have it either in the car or on your phone. You're going to be able to get to your destination, but in our world, without that GPS, it doesn't make much sense to do much of anything. If that resonates at all,
it does. It makes perfect sense, and it's a much better approach than a knee-jerk reaction to say, "Hey, let's respond to this little sliver because of this reaction and action," and it's much better to take a look at your entire portfolio.
Yeah.
And then you talk a lot about it, Chuck. If someone's in a position where this is a long-term type of proposition, maybe no changes are warranted. Or maybe after you review the entire portfolio, maybe you make some changes, but not that way. I don't
think, Harry, you make wholesale asset allocation changes unless your world changes. Now, so the question is, and it's kind of a good segue to sort of wrap things up here. As we know, U.S. equities, particularly S&P 500, made an all-time high yesterday. For stocks to move higher from here, we need some improving profit trends. We're seeing second quarter come. As I mentioned, Alcoa reported last night. A lot of the big financials start in another day or two. So we need to see improving profit trends rather than the multiple expansion as referred to it. We think we're going to see profit improvements as we get into the second half of 2016. But we're a little concerned that we might disappoint as the corporate sector ends up retrenching in response to these earnings contractions that we're seeing. And on top of that, you mentioned earlier during our discussion about geopolitical risks.
Yep.
November is right around the corner, so I think the world is going to spend a fair amount of time focusing on who's going to be our next leader, and ultimately what are the repercussions, positive or negative, by having a Democrat or a Republican, responsible for running our country. So with that being said, Harry, I think if the market closed right now today, based on where we are, we would set another all-time high, and that's obviously those are all good trends that your listeners should be happy with.
Good stuff, Chuck. Thank you, sir. Until we meet again in 1 week.
Harry, thanks again for having me. Have a good week.
You do the same. Enjoy the rest of your week. You've been listening to Chuck Malamut. He presents this program weekly right here during the Hurley in the Morning program. Chuck Malamut is a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, They do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. We'll be back in 3 minutes. If you want to jump in, it's a mini open forum segment, and it begins right now. 609-407-1450. 609-407-1450.